China today responded to its very rapidly cooling economic growth rates and recovery from harsh pandemic lockdowns by cutting its key interest rates at a time when the rest of the world are raising theirs in response to growing inflation. Joining me now, Warren Hogan, independent economist and a consultant with the small business lender Judo Bank. Warren, many thanks for your time. Here's the reality. We've seen only in the past week or so that China is not immune from inflation, but it's cutting interest rates. Why?
Well, their property market is imploding, and it's a very complex web of financial interactions. Developers are in trouble, financiers are in trouble, and of course what I think worries for the government is that there's a lot of savings wrapped up in that market. So they're trying to really take some pressure off that property market and of course take some pressure off the broader economy.
Okay, so this is about the Evergrande story, and Evergrande defaulting, biggest homeowner there, but a home builder there, but there's others as well. But the last time we saw a property collapse of this nature was the global financial crisis. So is there any danger that this triggers a financial crisis globally, or is this something that is really very much about the internal Chinese economy?
It's very much about China. The magnitudes of their challenge are similar to a GFC. They're a genuine financial crisis that's going on within that financial system, within that economy. But the big difference between China and what we've seen in the past is that they have a closed financial system. They have a managed exchange rate. Capital does not flow freely inside and outside of China. So A, you don't have a lot of foreign money invested in that market, so there's not a lot of contagion directly into the rest of the world. And B, of course, it's harder for money to flow out of China, although that is a concern at the moment as their interest rates are coming down, as their economy is weakening. The government, they'll be worried about capital flight and putting more downward pressure on their currency when there's inflation coming.
Okay, so it's not immune to inflation. If you cut interest rates, you risk that inflation taking off even more, which means at some stage they might have to chase that inflation to get it out of there. That could really spur a really significant problem for China.
They're walking a fine line. Their inflation is lower than in other parts of the world, or what it's measured by them, as best we can tell. Although it is picking up a bit. And the rate cuts are very small. We're talking about 10, 15 basis points on 1 and 5 year lending rates. They're still up around 3.5%, 4%. So their rates are still well above the rest of the world's. So I think at the moment they're prepared to try and make that balance. But clearly there is a lot of challenges in that economy. Zero COVID is not helping any of this. But their domestic economy is suffering. We've seen a lot of downward revisions to growth expectations just in the last week. In fact, it looks like Chinese growth is going to be 3 or lower, when, as we know, for many years, it was a 6% economy.
Okay, so then is there any danger, potential danger, just quickly, of a flow-on effect to Australia with coal exports, with iron ore exports, with a range of others?
There certainly is. I think we're already starting to see the iron ore price come off. And of course, met coal is not going anywhere like thermal coal, of course. So do we see that volume start to be impacted and these huge trade surpluses? Potentially, but I don't think it's a major concern for us. Those markets are quite fungible, so it's worth watching, but I don't think we're going to see a major shock coming out of China in the short term for our economy.
Warren Hogan, as always, great to get your input. Many thanks for your time.
Thanks, Ross.